In 1973 to 74, the OPEC oil embargo and the resultant recession took the S&P 500 index down a total of 47%. And many of the Nifty 50, for which it had been thought that no price was too high, did far worse.
Hello everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. In today's video, let's look at the July 2022 memo from the legendary super investor Howard Marks. Mr. Marks is co-founder and co-chairman of Oaktree Capital Management, the largest investor in distressed securities worldwide. He's also the best-selling author of investing and stock market-related books, some of which we have summarized on this channel. His memos are extremely popular in the investing community, with none other than Mr. Warren Buffett stating that he always looks forward to these memos. The July 2022 memo is titled, "I Beg to Differ." In this video, let's take a look at the top 4 takeaways from this memo. Before we start, please smash that like button so others can find this video as well, and make sure to subscribe to receive next videos on these memos. Let's continue. Takeaway 1. Investors must act different for above average return. Mr. Marks starts the memo by stating that in 1970s, there were a set of companies referred to as Nifty 50 that were considered unbeatable. "You can't be fired for buying IBM" was one of the key statements of that era. During 1973-74, there was a recession, taking S&P down by around 50%, and many of the Nifty 50, for which it had been thought that no price was too high, did far worse, falling from the peak PE ratios of 60 to 90 to multiples in the single digits. Thus, their devotees lost almost all of their money in the stocks of companies that everyone knew were great. This was Mr. Marks' first chance to see what can happen to assets that are put on the pedestal of popularity. Later in 70s, Mr. Marks started investing in securities considered uninvestable, and which practically no one knew about, cared about, or deemed desirable. And he was making money steadily and safely. He quickly recognized that his strong performance resulted in large part from precisely that fact. "I was investing in securities that practically no one knew about, cared about, or deemed desirable," he says. This brought home the key money-making lesson of efficient market hypothesis. If you seek superior investment results, you have to invest in things that others haven't flocked to and caused to be fully valued. In other words, you have to do something different. He believes that the route to superior returns, by necessity, runs through unconventionality. He shared a simple 2x2 matrix on this topic in one of his 2006 memos. In his view, the consensus opinion of market participants is baked into market prices. Thus, if investors lack insight that is superior to the average of the people who make up the consensus, they should expect average performance. He says you can't take same actions as everyone else and expect to outperform. The bottom line of the above is you can't hope to earn above average returns if you don't place active bets. But if your active bets are wrong, your return will be below average. It's simple. If you hope to distinguish yourself in terms of performance, you have to depart from the pack. But having departed, the difference will only be positive if your choice of strategies and tactics is correct and you are able to execute better. Takeaway 2. Second-level thinking is necessary for above-average returns. All active investors, and certainly money managers hoping to earn a living, are driven by the pursuit of superior returns. The basic idea behind second-level thinking is summarized as follows. In order to outperform, your thinking has to be different and better. In other words, being right may be a necessary condition for investment success, but it won't be sufficient. You have to be more right than others, which by definition means your thinking has to be different. First-level thinkers look for simple formulas and easy answers. Second-level thinkers know that success in investing is the antithesis of simple and involves answering deeper questions such as, what is the range of likely future outcomes? What outcome do I think will occur? What's the probability I'm right? What does the consensus think? How does my expectation differ from the consensus? Mr. Mark points out that readily available quantitative information with regard to the present cannot be the source of superior performance. After all, everyone has access to this type of information, and nowadays all investors should know how to manipulate data and run screens. Instead, their superiority has to come from their ability to do 3 things. Number 1, better understand the significance of the published numbers. Number 2, better assess the qualitative aspects of the company, and number 3, better divine the future. Obviously, none of these things can be determined with certainty, measured empirically, or processed using surefire formulas. Unlike present-day quantitative information, there's no source you can turn to for easy answers. They all come down to judgment or insight. Second-level thinkers who have better judgment are likely to achieve superior returns, and those who are less insightful are likely to generate inferior performance. Takeaway 3. Daring to be different also implies daring to be wrong. Most great investments begin in discomfort. The things most people feel good about, investments where the underlying premise is widely accepted, the recent performance has been positive, and the outlook is rosy, are unlikely to be available at bargain prices. Rather, bargains are usually found among things that are controversial, that people are pessimistic about, and that have been performing badly of late. Mr. Marx takes this idea a step further, moving from daring to be different to its related implication, daring to be wrong. Most investment books are about how to be right, not the possibility of being wrong. And yet, the would-be active investor must understand that every attempt at success by necessity carries with it the chance for failure. The two are absolutely inseparable. Every investor has to make a conscious decision about which course to follow: pursue superior returns at the risk of coming in behind the pack, or hug the consensus position and ensure average performance. Mr. Marx shares the story about a fortune cookie he received 40 to 50 years ago. The message inside was simple: the cautious seldom err or write great poetry. He proceeds to share, but what does the fortune mean? That you should be cautious because cautious people seldom make mistakes? Or that you shouldn't be cautious because cautious people rarely accomplish great things? The fortune can be read both ways, and both conclusions seem reasonable. Thus, the key question is, which meaning is right for you? As an investor, do you like the idea of avoiding error, or would you rather try for superiority? You can follow either path, but clearly not both simultaneously. Unconventional behavior is the only road to superior investment results, but it isn't for everyone. In addition to superior skill, successful investing requires the ability to look wrong for a while and survive some mistakes. Thus, each person has to assess whether he's temperamentally equipped to do these things and whether his circumstances will allow it. When the chips are down and the market makes him look wrong, as it invariably will. You can't have it both ways, and as in so many aspects of investing, there's no right or wrong, only right or wrong for you. Takeaway 4. Be a long-term player. Mr. Marx mentions that the questions he's asked these days are overwhelmingly around the outlook for inflation, the extent to which Federal Reserve will raise interest rates to bring it under control, and whether doing so will produce a soft landing or a recession, and if the latter, how bad. For him, all the discussion surrounding inflation, rates, and recession falls under the same heading, the short term, and his views on the short term are: we can't know much about the short-term future. Or I should say, we can't dependably know more than the consensus. If we have an opinion about the short term, we can't have much confidence in it. If we reach a conclusion, there's not much we can do about it. Most investors can't and won't meaningfully revamp their portfolios based on such opinions. We really shouldn't care about the short term. After all, we are investors, not traders. It's the last point that matters most, but the question is whether you agree or not. When asked whether we are heading towards a recession, Mr. Marx's usual answer is that whenever we are not in a recession, we are heading towards one. The question is when. He believes we'll always have cycles, which means recessions and recoveries will always lie ahead. Does the fact that there's a recession ahead mean we should reduce our investments or alter our portfolio allocation? I don't think so. Since 1920, there have been 17 recessions, as well as one Great Depression, a World War, and several smaller wars, multiple periods of worry about global destruction, and now a pandemic. And yet, the S&P 500 has returned about 10.5% a year on average over that century plus. Would investors have improved their performance by getting in and out of the market to avoid those problem spots? Or would doing so have diminished it? Mr. Marx believes in Mr. Bill Miller's formulation that it's time, not timing, that leads to real wealth accumulation. Thus, most investors would be better off ignoring short-term considerations if they want to enjoy the benefits of long-term compounding. 2 of the 6 tenets of Oaktree's investment philosophy say A. We don't base our investment decisions on macro forecasts, and B. We are not market timers. The possibility or even the fact that a negative event lies ahead isn't in itself a reason to reduce risk. Investors should only do so if the event lies ahead and it isn't appropriately reflected in asset prices. But there's usually no way to know it. No strategy and no level of brilliance will make every quarter or every year a successful one. Mr. Marx gives a wonderful analogy. If you wait at a bus stop long enough, you're guaranteed to catch a bus. But if you run from bus stop to bus stop, you may never catch a bus. For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive follow-up videos on Howard Marks Memos.